Most retail traders see a chart like this and think, well, support, price is probably going to bounce here and start to move higher, like it did here and like it did here. Fairly logical, except that the market does not bounces here, it moves straight through it, and so quite a bit of retail traders get stopped out here. And then this is where it gets interesting, because after having taken the liquidity, most retail traders, the smart money concepts most of all, will say, well, price has taken the liquidity, now bouncing, this is now going to go for the buy side liquidity right here, the double top liquidity here, perfect, except that it doesn't. And this is where you think, most retail traders think, well, the game is rigged. The market is manipulated. It should have gone up. It didn't go up. Market makers did something. That right there is the universal reflex that, most traders do as a self-defense mechanism. Because let me be brutally honest right here. It is so much easier to believe that a secret group of market makers somewhere specifically targeted your stop here and then again targeted your stop again and manipulated price down this way despite the support, despite the bounce on liquidity and so on and so forth. It's easier to do that than to accept that maybe there's a flaw in your methodology. Maybe your technical analysis is not enough to actually have a consistent view on the market. Because the point is that the market makers are not hunting your stops. They're not. Something else is going on which you're completely ignoring. This move right here is not random in any way, and it's not technical either. There's something more profound, the macro context. I'm not talking about some, abstract textbook economic theories. I'm talking about a simple and straightforward concept that even if you spend 6 hours learning about fundamentals, you will understand, you'll know about this, okay? It's a shift in interest rate expectations, the backbone of fundamentals, simple interest rates. Rate hikes are bullish, rate cuts are bearish, that kind of stuff. So what happened here? Well, the Fed hinted at what? Potential rate hikes. They did it at the very latest FOMC meeting, with 9 out of 18 FOMC participants penciling in a rate hike for this year, and I can add as well 6 of 9 of these actually pointed to multiple rate hikes. And as a result of that, the market did what? They priced in at least a 125 basis point rate hike by September. So about 2 meetings away. So this is what I would like you to understand, okay? From all of this. When this happens, when there is a fundamental catalyst moving price and driving the flow, whatever technical support you see on the chart, it instantly becomes irrelevant, okay? And obviously, I'm not saying it's completely irrelevant, because as you can see, the market did to some extent react to this support level. So it's not completely irrelevant. The chart matters, the levels matter, but it's not something from which you should expect, a substantial bounce to new high, for instance. It does not matter how many times price has bounced off this level or how oversold the RSI is maybe. None of that matters if the macro environment says that the dollar in this case has the advantage over the euro because of the macro context. This support right here in this case, it's made of paper. It's bound to break lower, as long as the context remains the same, of course, if it doesn't change. So trying to trade a technical support while completely ignoring the broader context is, to put it as simple as possible, a fool's game. Again, don't get me wrong, this does not mean the charts are useless. That is the pendulum swing, the traders swing between it, and destroys a lot of traders because they first discover fundamentals, and what they do? They realize the macro fundamentals dominate, and they throw the technicals completely in the trash. That's not the point of this. The whole point is that technicals matter in context. A support level in a bearish macro context is useless, but a support level in a bullish macro context, one that becomes an opportunity. So for a purely technical trader trading inside the vacuum of a chart of his technical knowledge only, well, this right here is potentially a long. Of course, it ticks many technical boxes. So what do? You could long here and put your stop loss here, target this, pretty good trade. It's on paper completely rational, except that the chart, the technicals on the chart are not the real world. Okay, that support line is not in control of anything. It's this that's in control. It's interest rate expectations in this case. It could be risk sentiment, it could be geopolitics, it could be anything outside of the chart. So what happens in this case? Obviously the support breaks because the fundamentals in this case support the dollar over the euro. Okay, so euro against the dollar goes down. And retail traders, what they do, they call for manipulation. But it's not manipulation. This is just traders ignoring the macro flows. You're thinking that a line on the chart matters more than a fundamental wave of capital generated by a fresh, important catalyst like an FOMC meeting. Just doesn't work like that. Okay, macro dominates. So how do you actually weaponize this knowledge? Simple. If you see a technical setup that directly contradicts the macro context, like obviously in this case you're trying to long the euro against the dollar on this support just because it's a support level, it bounced here and it bounced here, what should you do instead? Well, you should ignore this technical support and instead look for shorts. And this is where the illusion of technicals starts to play in. I'm gonna see in a second. So the technicals may look perfect, but the context is against it. So what should you do? You should ignore this support, or at least take it into account. If you're short, maybe you take some partial profits, maybe you take profits as well if you want, if you're short from up here, but you definitely don't long it because you're against the macro context. If the macro context is against the technical view, there's actually a very low likelihood of that technical view setup to actually work out. You want the two together. Now flip that to the opposite. And again, this is where the illusion of technical analysis starts to come in. And this is where the real trades are actually made. Because what happens when your technical setup actually aligns perfectly with the macro context? Well, that is a high quality opportunity. Think about it for a second. And again, this is the illusion of technicals because suddenly we've found a bearish setup here. Instead of the support, we can draw this trend line right here, and suddenly we've gone from looking for a long to looking for a short because look, price is retesting nicely the trend line, the structure, and it should go lower. Okay, illusion of technical analysis. You can see whatever you want to see on the chart. If you're a bull, you're gonna see a bull setup. If you're a bear, you're gonna see a bearish setup. You're gonna see whatever you want to see on the chart. So again, let's say that the macro context is bearish, which in this case it was. Price pulls back all the way into this nice breach trend line, which obviously it's a very simple, straightforward technical setup, break of market structure, retest. Well, you can look for shorts. Now we've gone from trying to buy this support because it's a support to instead, hey, understanding that the macro context is bearish for the euro against the dollar, this technical support is irrelevant, and instead this is more interesting. And that right there is the evolution of a trader. It's about contextual awareness, total contextual awareness. I honestly think this is the ultimate takeaway from trading in general, without a doubt. Contextual awareness. Yes, the chart is necessary. Without an inch of a doubt, it's necessary. I don't take a trade without a technical setup, confirming the fundamental view and timing the fundamental view. But technical setup, it's half of the story. So the task is to read the rest of the half before you actually put signs on a trade. So you have to be aware of the context to align with it. In other words, contextualize your technical setups with the macro fundamentals and your trading will be much better. And by the way, I'm not here just talking with no proof. I have a verified track record to show that this approach works consistently over time. So if you want to add a bit of fundamentals to your trading, jump onto this video for a full 1 hour long guide. It's totally free and it's the best way to get started. And it's right here on YouTube. So just click on this video and get started.